Morning, everybody. It's just turning 10 o'clock according to my watch, and I'd like to say welcome. Hopefully the technology will hold up and my broadband won't do its usual, which has been interesting over the last couple of months. I appreciate everyone's very busy, and probably this isn't the only Zoom or team call today, so we'll crack on if that's okay with everybody. Just to welcome you all, I'm Neil Sturmey. I'm a tax partner in Grant Thornton, and I'm on the Northern Committee of the IPF, as is my colleague Matt Jones, who chairs it. And we're really pleased today that one of our very well-known Northwest and UK businesses has agreed to present to an audience which is much wider than we normally have, which is normally a Northwest-based face-to-face. It's one of the few benefits of the lockdown, in that we now are able to share some thoughts around lots of different topics with the whole UK-wide IPF membership. So welcome to everybody well beyond the Northwest, and I hope you enjoy the webinar. So today my job is just to help, together with Matt, to make sure we pull things together. The format is very much short presentations from Akeel and from Sam, who I'll introduce again in a second. And at the end, we'll have a Q&A. So as we go along, if you want to put questions into the chat box, we will come back to them at the end and hopefully pull together a few key themes. So just to introduce the main speaker of today, we've got Akeel Malik, who is the fund manager of Urban Splash Residential Fund, which is quite a new fund. And the reason why I was quite keen to get Malik and Sam Lenehan, his associate director colleague in House by Urban Splash, to speak today is that I've known Urban Splash for a long time, for 20 odd years probably, and the new concept of the modular housing together with the new fund that's been launched just seemed really interesting to me. Obviously residential is a massive topic for the UK, and renting of homes is another massive topic. So a bit different perhaps to some of the seminars that we've done, but residential I think is really important. So over to Sam, who's going to kick off with the description of what a house is about, and then we'll flow into more about the fund with Akeel. So over to you, Sam.
Thanks, Neil, and good morning, everybody. Thanks again to IPF for having us, and again, IT pending. I'll quickly spin through some slides and talk you through the house business. Neil, can you see my screen? Is that working?
Yes, perfect.
Great. Great. So as I said, just as a sort of precursor to Akeel, who's going to talk more about the fund itself, I'm going to do a very quick spin through House by Urban Splash. So firstly, in terms of who is Urban Splash, so market leading sort of urban regeneration developer, 26 years old. We've done over $1 billion in GDV of regeneration schemes across the UK, from sort of as far south as Plymouth up to North Shields in the northeast. We were one of the early adopters and pioneers of loft living in the UK. We were sort of at the front end of the change in pulling people back into living in city centres in the northwest, specifically Manchester and Liverpool. And I guess one of the things that we are particularly famed for is our brand-led approach to development. Broadly speaking, our organisation is split into 5 areas. We have an internal construction arm. We've always been firm believers that if we can be totally involved, in control of the way we build our homes and our places, that we can gain greater control over the design and the construction. We have a residential investment and management arm, which Akeel is going to talk to you about in a bit more detail. But essentially, in the build-up to sort of the financial crash, we retained ownership over circa 900 units of our stock, and in doing so, had built an in-house management team to manage that portfolio. During the refinancing of the organisation during 2013, in the fallout of the financial crash, we sold 800 of those units to Places for People, but retained responsibility for the asset management of those properties. Similarly, we have a commercial investment and management arm, which is a sort of £100 million national investment portfolio of offices again across the UK. That's largely in partnership with the William Pears Group. And then we have the more traditional regeneration stuff that Urban Splash is known for, which is the conversion of mills into the loft style apartments. It's looking at our kind of larger regen schemes in Birmingham, Milton Keynes, Newcastle, so things like Park Hill. And then we have the house business, which is going to be the main topic of the conversation today. So the journey that's led us to where we are with the house business can broadly be split into 3 areas, which is R&D, alignment and focus, and growth. As everybody on this call is probably aware, it's no secret, there's a huge shortfall of housing in the UK. And we'd never really been interested in doing one-off house building or small-scale house building in Urban Splash. We'd always gone down the line pre-financial crash of looking at larger scale kind of apartment blocks, commercial offices that I spoke about before. We became very, very aware when speaking to our tenants that were leaving those apartment blocks that they were very, very rarely happy about leaving an Urban Splash designed apartment, an Urban Splash developed apartment, because they felt that they couldn't find the same design quality that they'd become accustomed to living in the new build housing market. They almost always were going from one of our apartments to a sort of period home, Edwardian, Victorian housing, that they were then undertaking some sort of renovation to get it into a space where they felt it was fit for purpose. And what we found really, really interesting is that they were almost unanimously unhappy about the fact that they were having to go through one of those projects. And so that got us thinking about why is there not something in the market that's catering to these people? And so what we tried to do was be the antithesis of all of the things that we saw that was wrong in the new build housing market. So we took a step back and re-looked at all of the great principles of period homes, and then looked at some of the other consumer markets and looked at how they were engaging customers, and just started to unpick all of the industrial paradigms that existed in UK traditional built sort of volume house building, and looked at how we could do something differently. And this was our first product, which is Townhouse. So as I said, we felt Townhouse was the solution to many of the kind of market problems. We looked at how we could innovate and change and take the best bits from all the sort of different precedents that we looked at. So the first thing was every single house that we built, we were adamant was going to be designed by a world-class architect. You seldom see that in new build housing at the minute. If I was being provocative, you could say that most of the new build housing stock that's built these days is designed by spreadsheets rather than designed by architects. Next thing we looked at was we were sort of horrified when you start drilling into new build housing market that actually most of the stock is priced on the basis of less information than you would get on the back of a tin of beans in a supermarket. We don't sell you a property that's priced based on how many bedrooms it has. We sell you space, and then we hand it over to you, and you design how you want that space to be configured. We also wanted to make sure that our house was set up so that the perimeter walls were the only structural walls in the building, so that the house could grow and evolve with you as the occupant. We looked at how we could make sure there was more space in all directions. Again, that kind of mass market product in the UK has slowly eroded away its floor to ceiling heights, looking to pursue those kind of little marginal gains in operating profits. And we really, really took a keen eye to look at embedding as much sustainability as we could into the product. Again, as part of that, we looked at how can we build these better, and we started looking at modern methods of construction. This was in about 2016, before MMC had been coined as a phrase. And actually, we got speaking to an organisation called Insulshell, who originally was talking to us about panelized construction, but eventually we decided that modular construction, building these houses one floor at a time in a factory and then transporting them to site, would be significantly better for the product. The quality would be better, the speed would be better. And we now have a product that has gone from taking 6 months in the factory and 6 months on site to build, to now taking, this presentation slightly out of date, it now takes us 1 week in the factory and 2 weeks on site to completely build a newly spec'd house. Our first pilot scheme, New Islingtons, won multiple awards. The success of it has been seen in the value appreciation that have moved from sort of 230,000 to sort of hovering around the £500,000 mark now. And so we started to realise after we'd done this pilot scheme that we were perhaps onto something here. As I said, that we looked at in all of our previous projects as an organisation, we'd always look to control that supply chain so that we could manage a more efficient growth curve in terms of innovation, learning, control over quality, control over design. And as a consequence, in 2018, we purchased the original organisation that had manufactured our product, so Insulshell, which had since been bought by SIG. We then bought SIG off-site from SIG PLC in 2018 and took full ownership over our factory, which we still retain today. That's now gone from producing 40 homes to this year it will produce circa 200 homes, and we believe in the not too distant future it will be producing 500 to 600 homes a year from that specific facility. And again, we continued that sort of portfolio approach and began building out some of our schemes in Newcastle. So this is Smithstock, North Shields, partnership with George Clark, and also another site in the northwest, Irwell Riverside in Salford. We then realised that in order to take the organisation to a space where we could really accelerate that growth, we needed some partners to work with us. And so in May 2019, we announced our new partnership of House by Urban Splash, which is a partnership between Urban Splash, Sekisui House, who are the world's largest house builder, and Homes England, the government's housing accelerator. So a bit more about Sekisui House. Sekisui House are the world's largest house builder. They've built 2.6 million homes since 1960 when they were founded. Market cap is circa 8 billion. They build roughly 50,000 homes a year currently, a large proportion of those coming from one of their 5 mega factories in Japan. They are at the absolute forefront of what we in the UK are calling MMC, but to them, they've been doing this since 1960. It's not modern methods of construction, it's just construction to them. We have Homes England, who I won't go into too much detail on, as I presume most people will know. Homes England Housing Accelerator, it's really important to us that we are one of the only organisations that the UK government has invested in at equity level, not just provided debt financing. And we also have Noel McKee as a minority shareholder. So Noel was the founder of WeBuyAnyCar.com and brings an enormous wealth of expertise when it comes to high growth startups and disruption through e-commerce platforms. We've now started to bring in new products to that market. So we brought in Mansion House, which is our first mid-rise typology, again delivering on that commitment to MMC. We've used a cross-laminated timber approach in partnership with an organisation called Egoin, building out of Bilbao. We're starting to look at more high density housing products for more city centre areas. So this is Row House. And we're starting to work on much larger schemes, such as our 43-acre site in partnership with Places for People, Port Loop, which will be 1,100 homes delivered over the course of the next 7 to 10 years. Northstowe, just outside of Cambridge, Wirral Waters, and we're now finishing off the last sort of phases at New Islington. The future of this organisation, we believe, is really, really exciting. So we're now focusing on really ramping up that pipeline with our new partners behind us. We're looking at diversifying our product range to unlock new markets, new areas, new customer bases. And we're looking at going through a massive level of innovation and automation in partnership with Sekisui House, taking from some of the learnings that they've done in one of their 5 mega facilities in Japan. And again, continuously looking with an open mind at which partners we should be working with along that way. We've got a strong belief that if there is somebody doing something better than we are, then we want to work with them rather than try and grow that expertise ourselves. And all of this is about creating great design-led places. A comment that I'm just going to leave you with before handing over to Akeel is something that we've always sort of said to ourselves, and is sort of underpins everything that we do at any of the urban splash companies, which is the ancient oath sworn by the citizens of ancient Athens, which is, we shall leave this city not less but greater, better and more beautiful than it was left to us, which retains a core part of our commitment to customers today. And I will hand over to yourself, Akeel.
Thank you very much. I think we were going to play a little video to just introduce the fund, but maybe I'll just give a bit of an intro on myself first. So my name's Akeel. I run the Urban Splash Residential Fund. It's a UK-based fund that we set up in 2018 to invest in standing assets. And now we'll provide a little bit more information with this video, and then I'll launch into the presentation.
Urban Splash have been building communities and regenerating areas for over 25 years. This fund is an opportunity for investors to be a part of that.
I've been developing property for the last 30 years, residential property around the country. We've now got over 200 colleagues working with us. And hopefully we've established ourselves as best-in-class developers, winning over 425 awards and really changing the face of some of our cities. There's something very special about every Urban Splash home. And we want to make this available to renters as well as purchasers.
On one particular outing with Tom, I was fortunate enough to visit Park Hill. What Urban Splash was developing could be very attractive to institutional investors. They have a high-quality product with a strong community feel, a significant and scalable pipeline, and an infrastructure required to manage all aspects of the value chain, from land acquisition to rent collection and property management. We set up a regulated fund structure. We hired Akeel as our dedicated fund manager and John as our independent chairman, and we committed our own capital to prove the concept.
Since inception, we've deployed over £20 million on 150 homes across 5 cities in the UK. We purchased 80 apartments in the iconic Lister Mills development. We own 9 modular houses at Irwell Riverside. Our commitment to design-led buildings and homes that people really want to live in are what set us apart. We have everything from studio apartments to 5-bed homes in the fund.
More and more people, particularly young people, want to rent rather than buy. People are moving jobs much more often. Transaction costs of buying with stamp duty and tax treatments become much more expensive. So there are many more people renting.
There's an opportunity for us to build a differentiated rental brand that puts the customer first and generates significant returns for investors. We've got a great management team with over 13 years experience managing 800 homes. We've proved the concept that what we're doing is scalable, and now we're ready to take it to the next level.
Access to the Urban Splash development pipeline is a major advantage to the fund. Part of my role is to provide comfort to investors that there is strong, independent oversight over that process.
The fund has a dual-track strategy. The majority of our investment will be in rental properties that can be held and generate recurring income for our investors. We'll also invest in properties that can be sold individually to realise full market value.
Stubbs Mews in Manchester are 3-storey modular houses. The Civic Centre in Plymouth, probably Plymouth's best building and most famous. We announced last year a deal where Homes England, part of the UK government, took a shareholding. Sekisui House, biggest developer in the world, took a shareholding, and we're expanding rapidly. We're acquiring sites in Milton Keynes, in Cambridge, in Windermere from National Trust, bidding for sites all over the country. Investments in the residential fund will make a real difference to the quality of our cities.
Perfect. So, I mean, sorry about that. No Oscars for me in that one. But hopefully that gave you a little bit of an overview about why the fund was established and some of the other people involved. So Tom Bloxham, they're the founder of Urban Splash, Paul Goff and John Forbes, who are also on our investment committee. I'll just provide a little bit more detail and then give plenty of time for questions to both me and Sam afterwards. So I'll run through, I think Sam's already provided a good overview of what Urban Splash has done over the past 30 years and the expertise that's been built up within the team there, both on the regeneration and development side and now more recently with house and the modern methods of construction. Another part to that is the vertical integration, so the in-house property management team that have been managing residential property now for over 13 years and who are focused on our portfolio every day. Background to the residential sector in the UK, which I'm sure a lot of you are familiar with, but just to explain why we thought it was a particularly interesting opportunity and why now as well. Then the fund itself, the purpose, which was to allow institutional and external institutional investors access to the Urban Splash expertise and the pipeline that Urban Splash has got over the next 3 to 4 years of over £800 million across the UK. And we've identified a portion of that to come into the fund. And what we've done so far, as mentioned in the video, we did a friends and family round, so committed our own capital, just over 20 million, to start building a seed portfolio. Feel we proved the concept, and now we want to scale that and take it to the next level. And I'll talk a little bit more about the pipeline, which Sam alluded to in his presentation as well. So, summary of this kind of new approach to residential property, or reimagining residential, as the webinar is titled. We think there are two components. There's the Live Well by Design, which is the organising thought of Urban Splash and all of our group of companies, and then there's how we're delivering that, which Sam provided a bit of detail on. And Urban Splash have used that to deliver schemes across the UK, so over 4,000 homes to date. And then also built up a track record in managing them as well. Over 250 people now in the group of companies, and where the fund sits in really is an arm's length relationship, so independent entity with a separate investment committee that has no connection to the other Urban Splash group, other than through Tom and Julian, who are representatives on there. And then we work closely with the different verticals. So through a framework and service level agreements we have in place with the residential team to manage our portfolio, the core functions, which allows us to piggyback and run things quite efficiently on finance, marketing, and other parts. And then on the pipeline side with House by Urban Splash and the regeneration and development arm. And the investment committee was set up right from the beginning to try and have make sure that this was accessible and suitable for institutions. So John Forbes is our chair. He was head of PwC for Europe for many years, their real estate practice, and now sits on a number of other funds, including the investment committee of the UBS Triton Fund, and helped us put the structure together. Paul Goff is one of our founders and managing partner of a fund called Star Capital, an infrastructure fund based in London, and brings 25 years of investment management expertise. Then Tom and Julian from Urban Splash bring the residential property knowledge, and our job as the fund management team is really to bring that all together and put it to work for our investors. A bit more information on some of the others involved. And the residential sector to us was particularly interesting from both the capital growth perspective and the income side, particularly in the low rate environment at the moment. So historically, over kind of chunks of 10 years, residential property outperforms other asset classes, apart from really tech stocks in the last 6 months. But we think that it's a very good wealth preservation strategy. And in the UK, that's also bolstered by the continuous shortage of houses in the UK market. So part of the solution to that is building more houses for sale, as outlined by Sam and House. But part of the solution is also the provision of rental housing, and that's also driven by a change in demographics, more people wanting flexibility, urbanisation, all the themes that we've all heard of. And what's attractive from an investment perspective, as well as the capital growth, is the resilience of the income stream. So historically, throughout crises, although capital values of assets clearly go up and down, the income stream from residential property has been quite resilient. And then you combine that with the long-term trend of increased renting in the UK, and it makes it quite an attractive proposition. We think an additional layer to that is where Urban Splash have spent the past 30 years building up partnerships and their expertise, which is the regional cities in the UK. And not only are the rental growth forecasts in regional cities higher than in London, but they're also attractive from an affordability perspective. So in London, typically people are spending 40% of their income on rent. In the regions, it's more like 25 to 30%, which we think means that there's a bit more headroom to absorb any rental increases that may happen over the next few years organically as well. Whereas in London, it may be a bit constrained. The other thing I'd like to just point out is some of the information on our seed portfolio. So if you just see the average acquisition cost to date there of £165 and the average monthly rent of £760, we think that we are quite well positioned for the majority of professional renters in the UK. The average rent to income ratio on our portfolio is just over 21%, which means that people are well insulated against any downturn as well. And typically, someone's house is the last thing to go in a crisis. It's the Sky subscription, the meals out that people cut back on, but the rental income stream is quite resilient because people will always need a place over their heads. So the background to the professionalisation of the sector is the UK residential market is huge, larger than the commercial market. Only a small proportion of the PRS sector, only 3%, is currently owned by institutions. A lot of appetite for institutional investors, but constrained by the availability of stock, which is again where our relationship with Urban Splash as a development company helps us deploy capital into that as well. And we want to do it slightly differently than some of the other funds and large residential landlords out there. We don't really believe in the highly amenitized city centre large blocks that are sometimes targeted at the top 5 to 10% of renters. And there are housing associations better placed to deal with the social housing side of things. We see ourselves as covering that vast middle ground, which is providing great places to live at reasonable rents and accessible to the majority of the UK population. And so the fund to date, these are examples of some of the homes in the fund. So Lister Mills in Bradford, Port Loop in Birmingham, Park Hill in Sheffield, and this is the Civic Centre in Plymouth in our pipeline. What unites them all is differentiation. So this focus on design, community, giving people places to, outdoor places to mix as well. And diversification has been important to us right from the beginning, both from a risk perspective, so making sure that rental income stream is as resilient and robust as possible. So from day one, we wanted to have geographic diversification. So although we've had a limited amount of capital so far, we're in spread across 5 cities in the UK. And we have all different house types in the fund as well. So everything from studio apartments to 4-bed houses in the fund, which gives us a diversification of tenant type as well. The past few months, or 6 to 8 months, have been a challenging time for everyone. But one of the silver linings for us has been that we seem to be getting quite a lot of inbound from tenants looking at our properties because they're well positioned for the new normal. So a lot of them have home working spaces. And I think these are some of the trends in the residential sector that are going to be increasingly important going forward. A lot of our homes have private gardens. All of them have access to outdoor communal spaces, and they're all very well connected. And that, combined with a customer focus, which is becoming increasingly important, has enabled us to have a rent collection rate over the past 8 months of 95% on average, and occupancy has actually increased to this week is 99%, and our long-term average is 95-96%. So that comes from listening to our tenants, speaking with them regularly. We've got this in-house team of 20 that are on the phone to our tenants every day. We're using technology to make it really easy for them to communicate with us through a resident app, and then also in-house CRM systems to really understand our portfolio and try and make sure that we're managing it as efficiently as we possibly can. On the acquisition side, there's a similar sort of rigor. So any acquisitions we make, whether that's through Urban Splash or third-party acquisitions, have to meet this strict set of criteria. Typically, minimum gross yield of 5%, sympathetic to the community. And when it comes to sourcing, we've got the access to the Urban Splash pipeline, which gives us two sorts of opportunities. And we believe that the pepper potting approach, although different and does limit the control over the resident experience, because we'll typically acquire a number of apartments or homes in a wider Urban Splash scheme, we do retain a bit of that control through the building management or estate management company. And we also have the ability to sell some of those homes individually, realizing liquidity and recycling capital, although we keep that kind of below 5% of the portfolio each year. And then now, as we're raising this larger amount of capital, we'll look to make some increasingly block purchases where we have full control over the tenant experience as well, and really drive the income stream and manage them efficiently. We are also constantly benchmarking third-party opportunities, and we're seeing quite a lot of stuff out there, although difficult to find opportunities that compare to the Urban Splash pipeline and the sort of pricing that we've been able to achieve on that, on the £165 per square foot acquisition cost, with a similar level of quality. But occasionally we'll find one like this, the Chancel purchase from Granger earlier this year, which provided a great opportunity to add the Urban Splash marketing, do a little bit of work in the communal areas, and increase rental values. This is an overview of the portfolio so far. So we've deployed the 20 million that we raised. I'm looking at a 30% uplift on valuation. And then this is a bit more information on some of the schemes, but I won't spend too long on them. But each one has a story. So this was the largest silk factory in the world. Urban Splash put these roof pods on top. We acquired 30 of those and 50 in the main building. Great 23% capital uplift on sales we made there. Park Hill in Sheffield, more of a block and right next to the train station, really well located with 2 universities. Sheffield's a really strong rental market at the moment. And we've got a kind of 7% like-for-like rental increase over the past 12 months, and always occupied. Well, Riverside in Salford, these are right in Manchester city centre, and 3-storey townhouses, 2 and 3 stories with private gardens, and very popular with all sorts. So downsizers, young families that want to be close to the city centre, young professionals that are there for a shorter period, a real mix of tenants. And then similar story with Portloop in Birmingham. And the house product by Urban Splash has been really popular and enabled us to set new rental levels and new capital value levels in the areas that we've gone into. And Sam mentioned earlier about the track record in areas like New Islington, where there's typically quite a strong value increase over time. And really the fund is here to take advantage of that as well, because Urban Splash go into areas with quite low values that need a lot of investment in placemaking and regeneration. And then typically the uplift comes 3-5 years later. So we have the opportunity to buy in at the beginning of a scheme, or often at a discount, due to bulk acquisitions at the beginning or end of a scheme when the developer needs to move on and recycle capital. And then we have the ability to use our in-house rental team to rent those quite efficiently. So here's an example. We went to this area, spoke to a couple of agents, and they guided us on the rental target of £1,200, £1,300 a month. We ended up achieving £2,000 a month on those. Copper Building in Bristol's the old Imperial Tobacco headquarters. We acquired 18 of these, and because of that in-house team and the ability to start marketing before completion, they were all fully occupied within 3 weeks. The Chancel in Manchester is this third-party acquisition we made, which because of an issue with the head lease that we were able to work through, ended up getting a really good 33% discount to market value. The plan here is to improve the communal areas, hold a core for rental, and gradually dispose of some of these. And this is that in facts and figures, really. So the average acquisition cost per square foot to date, and then the sales prices we've managed to achieve on the disposals we have made have been at an average 40% premium to that, and a 14% premium to the higher of the Savills valuations of our portfolio at year end, which gives us confidence in the valuations as well. And we're always trying to understand the portfolio a bit better. I think that's become increasingly clear over the past months that it's really important to understand the mix of our tenants, and also their income levels and what that means for our income stream. And so we did a bit of analysis, and the average rent to income ratio for tenants in our portfolio is 20%. Our property is typically at a premium to others in the local area, but still affordable. So about 60% on average of people can rent one of our properties and spend less than 30% of their income on it, which is kind of commonly accepted as affordable with a lowercase a. And so to recap, the strategy for us is build a diversified portfolio of rental properties acquired at a low capital cost, manage them in-house to really drive the rental yield, and then regularly see whether any of those pepper potted acquisitions should be disposed to increase returns to our investors, but keep that to a small portion of the portfolio. Our target returns are a target net 10% per year, and that's comprised of an income dividend distribution of 3% currently, looking to rise to 5%, and then the remaining capital uplift. And I think important to stress that to date, we haven't got any leverage on the fund. We'll look to put a moderate amount of leverage on there. And we don't take any development risk, so we only acquire standing assets. Another important part of our strategy is, as it is for many people, investing well. And this is something that's been core to the Urban Splash philosophy since the company was founded, and something that we try to do throughout all group companies. And Sekisui House, who are involved with House by Urban Splash, have a great track record in this. And John Forbes, who's our chairman, is also very helpful in terms of setting our policies on this. So we've invested a lot of time in that. And then the pipeline. So the plan now is to raise £100 million from institutional investors, and that's to primarily be deployed into the identified pipeline we have through Urban Splash, and also make sure that we can take advantage of any third-party acquisitions that we see. And this is just a quick overview. Northstowe and Cambridge, really interesting rental market for us outside Cambridge city centre, where a number of people that are working in the tech community and scientific community there that want access to modern houses, which aren't so common in that part of the world, at reasonable rental levels and with an element of flexibility. And Urban Splash are delivering over 400 homes there. We've identified a portion of that for the fund. We look on each scheme that we have to contribute to the community and put together an ESG strategy. Portland and Birmingham, similar, we acquired some homes there. It's an island site in the middle of Birmingham, 15-minute walk from Birmingham city centre, over 1,000 homes there over the next 5 to 10 years. And in the immediate future, so over the next 2 years, we've identified about 70 of those, or £25 million worth of property that could come to the fund. And lots more going on all over the country. but I'll leave it there, and I think hand over if there's any questions.
Thanks, Akeel. Thanks, Sam. I feel like I've had a trot around the entire UK there. I did spot one or two local ones as well. Wirral is where I'm sitting. Interesting.
Yeah.
Joint venture with Peel, isn't it? So, yeah, that's why we thought it was interesting for the audience just to get a better insight into what's going on. And just looking at the questions we've had, there are certainly plenty of interest in the topic. So perhaps if I can just ask you for the first question, actually, Akeel. Question is that base case yields are averaged over the hold period. What are the initial yields, net yields?
Yeah, so varies by scheme. The current net yield on cost of our portfolio is 5.5%, and we look for a minimum of 4.5% on the schemes that we're going into typically.
Okay. And a sort of follow-up question about yields.
Okay.
Does the gross yields look attractive? But assume you have to make provision for refurb and redecoration of your properties. What does that do to your total return?
Sure. So that's reflected in the net yields that we have there. We actually manage to, it varies by property, and there's a difference between house products, for example, and the other regeneration schemes. But house gives us the ability to manage properties very efficiently. So because it's the same property type across the UK, we're able to then refine our maintenance strategy, make sure that we can replace things quite easily. And then one of the important parts of this vertical integration as well is we feed back that information to the factory, and then future product types often incorporate that. So constantly reducing, I mean, the gross to net on our portfolio, again, varies. So there's about 10% is on the lower end for the house products, up to 25-30% on some of the older listed buildings like Lister Mills, Park Hill, but we'll acquire those at higher gross yields initially. So it all balances out at about a 5 to 6% net yield.
Okay. One quick question for Sam. How important is modular in all this? Is that the main attraction of the organisation, or what?
So modular MMC is really important to us, but we are very much of the view that MMC isn't the USP. The USP is actually focusing on the end user, which is something definitely being forgotten about in the house building value chain in the UK. And we believe the area that will allow us to disrupt the market and do something very, very different is enabled by focusing solely and obsessively on the user of the house, rather than being pulled in one direction by planners or the wide array of consultants who work on any given development. So it's that customer focus that's the USP. MMC just enables it to be delivered in a quality and quick timely manner.
Okay. Matt, I think you had a question.
I think we've only got a couple of minutes left, really. Yeah, I think we've only got minutes still left, really. But another one's just come in from David Fleetwood. Akeel, how scalable is the fund? So what size do you think you could grow it in what time scale?
So the ambition for us is to build this into a £1 billion plus portfolio of rental homes across the UK. We want to make this accessible to retail investors in the long run, but are looking to do this institutional round as a way to build scale over the next few years. The Urban Splash pipeline is great for us because it means that we can identify, as mentioned, £800 million over the next 5 years or so, and that's growing every day. And as Sam has mentioned, that business is a real growth business, and the ambition is for that to become a leading house builder. Also, as we scale, there'll be more opportunities outside Urban Splash that we can take advantage of as well. So we're looking to do this 100 million raise, which will take us to kind of reasonable scale over the next year or two, and then we'll look to add to that in 5 years or so as we expand the fund further.
A couple of other questions we've probably got time.
You mentioned there about acquiring from Urban. Akeel, is there any conflict to manage there?
Yeah, so something that we were very sensitive to from day one is clearly the connected party there and potential for conflict. But the way we've mitigated that is to really focus on our investment committee, have John Forbes there and Paul Goff, very experienced individuals, also an investor advisory committee that will run transactions passed over a certain level. And so we try to incorporate that, yeah.
Perhaps time for one final question. Obviously, environmental and sustainability is really important to the concept. You mentioned that particularly. One question we've got here from David is, I assume the carbon approach is heat pumps. Was it another approach or a mix?
So the carbon approach differs depending on the product. There is a real ambition, and working with Secretary House, who build 76% of the 50,000 homes a year that Secretary House build are carbon net zero. So we will be to take from the wide array of different technologies and principles that they use and apply that to our future pipeline and portfolio.
Okay, great. I think we'll just absolutely one final question because we want to try and stick to time. Do you intend to do the pepper pot approach also on assets that do not come out of our urban splash development?
So it's not a blanket no, but we'd have to look at it quite carefully. Having the control through the appointment of a building manager or estate manager means that on urban splash developments, the pepper potted approach, we still have an ability to have some control over the resident experience. We would be quite careful about doing that on third parties, but always looking and evaluating the opportunities.
Okay, that's great. I think as time has passed very quickly, actually. I really enjoyed that. We'll bring it to a close just by thanking Akeel and Sam. I found that fascinating. I said at the beginning, I know urban splash pretty well, but this is such a topical area of interest of mine as well. I just thought it was fascinating in what was a relatively short period of time. If anyone's got any other questions, I'm sure you can make contact with Akeel and Sam, because there's a very nice website with lots of videos on there, I noticed. So I'm sure you guys are happy to take further questions and be contacted by anyone on the webinar today. So thanks very much, everyone. Been a pleasure. Thanks, Matt, for your help on the Q&A, and look forward to seeing you all again, hopefully face to face in the not too distant future. Take care, everyone.
Yeah, great. Thank you very much.
Yes, thank you. Bye.
Thanks, everybody.